I'm a CPA and accredited business valuer with my own firm, Ryan Gear, Field and Rhodes. We have an office in Matthews and now recently got an office in Carmel Executive Park. We cater for small businesses and small business owners. And we do primarily tax, monthly accounting and bookkeeping, full service accounting and valuations. My particular interest is valuations, and it touches onto M&A advice, and I team up with Joe and Alan on that side of things as well. And I want to do this in a conversational style as best as possible. I know, as Tom says, it's a topic we all love to hate this time of year. I particularly hate it at this time of year because we get inundated. But it is an area we have a bit of expertise in, so I guess we've got to do it. Just so I can explain, Ryan Gear, Field and Rhodes is the legal name of our practice, North Carolina registered CPA firm. We are a member of Russell Bedford International, which gives us representation pretty much throughout the world. But certainly I think there are about 11 firms in North America and a bunch of firms in South America. So if you know of anyone who needs help in anywhere else in the country, then let us know. We can refer you to someone there. So the issues I thought about how to do this. I don't want to make this super technical, so if I'm saying things that you think, hey, I know this already, just bear with us. I'm hoping to generate a bit of a conversation and maybe just talk about some of the concepts behind tax. And I've picked out some items, and this is no way exclusive. There's a bunch of stuff that happened last year with Secure 2.0 and Inflation Reduction Act and various other things. So I've picked some items which I hope will be interesting, but please, if you've got other issues that you think about as I'm going along, let's talk about it. If I don't know the answer, I'll get it and get it back to you. I do have copies of the notes. If you want to give me your business card afterwards, I will happily email you a copy of this presentation. So the topics I've picked to talk about is just that every year the IRS updates the limits and deductions and things like that. So I'll go through some of those, the common ones initially. There were some changes to tax credits. Everyone likes tax credits because that's money back from the government. So we'll talk about some of those. The Patient Protection and Affordable Care Act, PPACA. That's got some interesting information for us. Inflation Reduction Act, I mentioned that, was passed towards the end of last year. And then Secure 2.0 was actually passed on the 29th of December 2022. So the impact has hit us in 23, which means you'll be working off that in your current tax filings. So in terms of the various limits, the US, as most countries in the world, work on what's called a progressive tax system. I think that's supposed to be here. So a progressive tax system, the general concept is that the more you earn, the more you should contribute to the fiscus towards the payment of taxes in a country. So that's why we have a system of brackets, and you start at the lowest level at about 10%, and you work your way up in bands of income. And the top level, I think, is 37% from memory. And that's just federal. So, and then obviously you add to that your state. In the state of North Carolina, we have a flat tax rate of 5%. Other states have varying levels. So it gives you an idea, but the brackets go up every year to accommodate increasing earnings. So we've got a high inflation rate, so 7% was the increase in the tax brackets for 2023. The effect of that is that in theory, you're going to make more money and you'll pay less tax. Not many people have got more money because I don't think there were big wage increases last year. I think average was 4%, so you're probably a little bit better off. Standard deduction, again, this is, you guys might remember back in 2017, you used to get a standard deduction and you got an exemption. So what that means is the government said, the IRS said, we'll give you a standard deduction. So it was about $15,000. Think about that. That means basically if you earn $50, you don't pay tax. It's really a break for lower income people. And the bigger that number is, the bigger the break is. And then the other thing they used to give you was an exemption, which was based on the number of dependents. So if you had a lot of children, the theory was that you needed more of a break, so you got a bigger deduction. In 2018, away with, exemptions gone, the standard deduction was increased, pretty much doubled, and that had a couple of interesting consequences. So you can see what the standard deductions are for this year, and they vary depending on your filing status. So single or married filing separate, head of household, and MFJ. I use those initials all. Married filing joint, probably the most popular filing, maybe up there with head of household. Head of households if you are not married, but you have children. Okay, so head of households if you are not married, but you have dependents. And it's also quite a popular filing mechanism, particularly with lower income people. So just on that 2017-2018 thing, that was, it's called the Tax Cuts and Jobs Act, and that expires in 2025. So the jury's out on whether it gets extended through 2026, but at the moment the rule is that we will go back to a lower standard deduction and exemptions. The other interesting thing about standard deductions is that your standard deduction is supposed to compensate you for medical expenses, state and local taxes, mortgage interest, and charitable deductions. If you add those numbers up for your particular situation, and it comes to more than that standard deduction amount, you're entitled to claim that. That's called an itemized deduction. With the standard deduction going up to what it did, to what is it here, 27,000 if you're married filing jointly, not many people have been able to itemize. So a lot of the charities and non-profits have been hard done by because they're saying there's less incentive for us to contribute to charity because we don't get a tax break. We're already getting 27,000 tax deduction, so why are we going to make an extra charitable contribution if we're not going to affect our taxes? So there are some strategies around that. Donor-advised funds, I don't know if you've heard of donor-advised funds. They've come in and become quite popular because they're a way of trying to accumulate your charitable contributions over a number of years and get a big deduction which may exceed this larger standard deduction. So a whole lot of planning consequences coming out of that, just that little change that was made. Business mileage, if you have your own business, you are entitled to claim mileage as a tax deduction. So when the rule for vehicles, if you have your own business, is you can either claim the actual costs, which would be the depreciation of the vehicle, the wear and tear, the gas, looking after those costs related to the actual maintenance of the vehicle and running the vehicle. Either that, or you claim mileage. And the rates are shown there that you can claim for business mileage. You can claim for medical and charitable, but they're usually such small amounts, very few people claim them. But just remember that when you do your tax return, if you're not going to claim actual, you can always take your mileage times 62.5 cents a mile. It's usually quite a nice deduction. And you claim it in the business as a reimbursed expense, which you don't have to then report as income in your own hands. Talking about mileage, one of the other things that went away in 2017 is we used to have a thing called unreimbursed employee expenses. So if you, particularly sales reps, they like this because they would get commission on their W-2, but they'd driven 60,000 miles a year, they'd get a $30,000 tax deduction on their itemized deductions. Well, not only does that get limited because the standard deduction is so high, but now you're not even allowed to claim it. So what I recommend to a lot of my business clients is if you want to do that, set up what's called an accountable plan. The IRS has strict rules for what's called an accountable plan, which is basically a reimbursement plan, and use the employee, submit a reimbursement claim to your company, even if it's your own company. But there's certain rules. Make sure it's you follow the rules and you've got vouchers and it's all justified. Then you can claim that as a reimbursable expense. But if you're on W-2, I'm afraid there's nothing you can do. Nothing you can do with that. Moving on then, this probably should come under the credit section, but it's an interesting area. Education credits, again, part of the progressive tax system to try and help us with kids at school or maybe our own schooling to pay for the cost of college and education. The most popular one or the best one is what's called the American Opportunity Tax Credit, AOTC. Basically what that does is it gives you a deduction on the first $4,000, up to $2,500 of your first $4,000 that you spend on education. That's tuition and books, not board and lodge, just tuition and books. So it's quite a nice deduction. It's $2,500 of which $1,500 is refundable.
Is that trade schools too, or just traditional? Is that trade schools too, or just traditional education?
Any education, any tertiary education? Yeah, any tertiary education. The trick is, if your income's over 180,000, you don't get it. So there's an income limit, obviously intending to help folks who are not earning as much.
Right, what about like a lot of people are doing certifications now.
Yeah.
Is certification or other type of stuff?
No, that's
more
good,
business
good,
education, that's not education.
Good question, because one of the requirements for the AOTC is it has to be a college leading towards a degree or diploma. There is, though, the lifetime learning exemption, at least deduction, lifetime learning credit, beg your pardon, which you can also get for that type of thing. And then there is also a business deduction that you can claim for education. And obviously, if it's business related, if it's like CPE, you can claim that as a regular deduction in your business. Yeah. So moving on. Where am I now? Long-term care premiums and benefits. I just put this in. It's fairly arbitrary, I guess, but it's interesting. If you're paying for long-term care, and I was actually at a presentation last night, apparently the long-term care industry is really struggling because the cost of long-term care has gone up so much, a lot of the carriers just don't want to cover it because they can't cover it. It's just they're going to lose money on the premiums they quoted. But anyway, there are a lot of policies out there. You can get a deduction for your premiums, but it's based on age. And it falls into that medical expense category. So I didn't talk about this earlier, but one of I said you can claim your medical expenses as part of your standard deduction stroke itemized. You can only claim medical expenses to the extent that they exceed 7.5% of your income. So for a lot of people, that counts them out. You earn $100,000 a year, you've got to spend out of pocket $7,500 before you even think about it, and then anything there goes into the standard deduction bucket of $27,000. Well, you really got to go some to get a deduction for it. So it's a bit disheartening, especially when we're trying to help people with medical costs. If you have long-term care and you're getting a benefit from it, it's paying you out, you can exclude $420 a day. So it's not taxable up to $420 a day, which I think is pretty generous. Social Security tax, I'll just mention that because this is a case of a regressive tax. I've never really understood it, never argued with it because it's hefty tax. But if you earn more than $160,000 a year, you do not have to contribute Social Security tax. So Social Security tax is 6.2% paid by the employer, 6.2% by the employee, 12.4% overall. It's a hefty tax. So if you earn more than $160,000, you don't have to contribute. So I've got a client who does earn more than that. In order for them to maximize other deductions, we want to really whack up their salaries. If they're over $160,000, it costs very little to push their salary much higher. It only costs the Medicare tax, which is 2.9%, split evenly. So, but if you're starting from zero and you want to do 401k contributions or something like that, you're going to pay Social Security tax on your 401k contribution earnings. So you got to weigh that up. Yeah.
Is that
all the earnings over 160, or does that go back to all the earnings back to zero if at the end of the year you have over 160?
Let's run that by me again.
Do all the earnings over 160?
All the earnings.
So up to
He's
160.
asking about the cap.
Up to 160, you pay the 12.4%.
Correct, yes. Over that, you do not pay. That's, yeah.
160 has zero.
Yeah, that's why I say it's regressive.
Regressive, yeah.
Because in theory, the higher earners should be paying the tax and the lower earners wouldn't be. But I guess the theory is that most of the people who are going to claim on Social Security would be the lower earners. So, I don't know. Anyway, it's an interesting planning consideration as well. Foreign earned income, probably not applicable to most people, but if you go and work overseas, if you're a US citizen, you have to file your tax return anyway. It doesn't matter if you're in Portugal or wherever you are. But if you are working overseas and you qualify for the time periods that allow for this exemption, then you can exclude $120,000 of your income from US tax. You presumably would be paying it wherever you're working. So I've got a client who's moved to Portugal. They pay Portuguese tax on all their income, but at least they don't have to pay it again in the US for the first 120. Estate tax, just because it's interesting, estate tax is a very different tax. It's when you die, all your assets are added up, they're valued, and subject to a 40% tax. But if you earn, if the total that comes to is less than 12.9 million, then you don't have to worry about it. So pretty much most people don't worry about it. There is talk that that's going to be lowered, but that hasn't happened. That is also portable, which means you can pass it to your spouse. It's effectively 25, 26 million. So most people don't have to worry about it. If non-residents do, interestingly, if you're a non-resident with assets in the US, 160,000 is your exemption. Everything over that is 40% off to the government. And interesting that they're talking about tax on unrealized gains. Don't know if you've seen that in the press, but there has been talk of maybe introducing a tax on unrealized gains. So say you bought Apple 5 years ago for $1,000 and it's now $3,000. They're saying, well, that difference between 1,000 and 3, we're not going to wait till you sell it. We're going to want you to pay tax on it now. $2,000 times whatever. And that's kind of an estate tax, because you say, now you die and it's worth 3,000. Why am I paying the capital gains? Plus I've got to pay another 40? Yeah.
Do you think that's going to happen?
I don't think so, but somebody raised it at a presentation I was at last night. And he said to me, what do you do to mitigate that? And I thought, well, on the spur of the moment, the only thing I could think of was life policies.
Chris, didn't they, way back, didn't they used to have it where they gave you the choice of pay the capital gain at sale or pay the unrealized, difference to basis every year as you go and reset your basis up? Didn't they used to give you a choice on those?
I'm not aware of that. You might be right. I'm not aware of it. It would be pretty onerous. It would be a big thing to lump onto people. Okay, so where was I then? I think I skipped a page. Section 199A. Let me just get myself orientated again here. Sorry, folks. Section 199A. This was a big issue, 2017. It's called the QBI deduction, or the Section 199A. Those of you remember Julie used to be with us. She was big on this. She did a lot of presentations on this. Basically, a really cool thing for business owners. If you're a pass-through business owner, which is a partnership or an S-corp or a sole proprietor, you can deduct 20% of the profits on that business from your income. So it's an extra tax deduction. It's a really nice one for a lot of people.
And that's due for phase out. For expiration.
That is indeed right. Exactly.
That's on the document.
That's on the, yeah. So it'll be another one of those things. Interesting to see if people like it enough that they're going to kick back, but yeah. It does have a phase out. SSTBs, we love our acronyms. So SSTB is a specified trade or business. I don't know what the other S is for. Anyway, specialized. Anyway, never mind. It's basically a business where you make money off your own skill. So accountants, attorneys, artists, people like that, they are limited in the amount that they can claim for this, and the limit is based on their income. I mentioned alternative minimum tax, just so that you're aware. There is a concept out there that, hey, you're really wealthy, you've made a lot of money, we're going to subject you to a different formula for calculating your tax. And it basically disallows certain expenses. And in your tax calculation, you'll complete the schedule. It's Form 6251. You'll fill the form in. And if that number comes out bigger than the amount of tax you owe doing it normally, you owe the bigger number. But there's exemptions in it so that most people don't actually end up having to do it. So that's the one we just discussed earlier. Oh, I wanted to mention, just on that estate tax, the gift tax. If you're looking at estate planning or anything like that, you are allowed to gift up to $17,000. I think it's $18,500 in 2024, but you're allowed to gift $17,000 without having to report it to anyone. So the way estate tax works, I was telling you about how you add up all your assets at the end of your life. If you've been gifting assets through your life, say you really have a good year and you get a bonus of $500,000 and you want to gift that to your kids, you've got to file a form to report that gift. And then when you pass, the IRS comes along, adds up everything you've got when you died, and they go back and they find that form and they add the 500 on as well. So if you want to gift, you can gift up to $17,000 per donee, per recipient. So if you've got 5 kids, you give them each $17,000. That gets your estate down so that you potentially don't have to pay estate tax.
That's per year.
Sorry?
Per year.
Per year, correct. Yeah. And there are other things you can do. If you've got a 529 plan, you can accumulate them and do stuff like that. Okay, tax credit changes. This came in the Secure Act. The retirement savings contribution credit, it's been there for a long time. It's really there to help lower income individuals who want to contribute to 401ks or IRAs. And basically what it says is that you can get a tax credit. In other words, the government will give you money off your taxes for up to 50% of whatever you contribute. So if you put $1,000 into an IRA and you're in the lower income levels, then the IRS will give you up to 50% based on the amount of income. But I mean, it's like 43,000. You get to 43,000, it goes down to zero. You don't get any, 50% comes down to zero. So it's just handy to know if you've got children who are starting out working and they want to start saving. It's a nice thing when they've got lower income levels. Additional child tax credit. Just so that you know, there's a distinction between a refundable credit and a non-refundable credit. Most tax credits are non-refundable. What that means is you do your tax calculation and it ends up before you deduct withholding tax and that sort of thing. Say you owe $10,000. Your tax charge for the year is $10,000, and you get a tax credit of 2. Well, then that's fine. The IRS will say, I'm going to take the 10 less the 2, you owe 8. And then they'll look at your W-2, your estimated taxes, see how much you paid. And the net of those two is whether you get a refund or you owe. That's a non-refundable tax credit because if you don't get any money back if you don't owe tax. Some credits are refundable, like the American Opportunity Tax Credit we talked about earlier. Up to $1,500 of that is refundable. And this additional child tax credit. So if you're able to claim, say you've got 2 children, and you get a $4,000 child tax credit, but you haven't got a big enough tax bill to cover that. If you only had $3,000 in tax for the year and your child tax credit's 4, you would normally only be able to claim 4. But because of this additional child tax credit, that's a refundable portion. They'll give you $1,000 back out of the 4 as a refund, actual refund in your bank or as a check. Sorry, this thing's giving me trouble, yeah? Earned income credit, pretty much limited to lower income people. A lot of the H&R Blocks and Jackson Hewitts, they deal with a lot of these type of claims. But basically, this is a tax refundable tax credit you get for working, and up to 56,000. But the way it works is like a bell curve. So if you get sort of halfway through there, about $28,000, that's where you'll max out, and you could probably qualify for about 7,000. So it's quite a nice number. But as you earn more and more, it peters out and comes down to zero. And it's quite interesting because a lot of people, when I used to be in that industry, a lot of people will actually work up to the point, they'll figure out what that number is, and they'll work up to that point, and then they'll quit for the rest of the year. And then the 1st of January, they're into the tax office, get their refund, and that's how they operate, each to their own. Adoption credit, I just mentioned that. Didn't know you knew if there is an adoption credit to help with adoption expenses up to $15,000.
Is that a one-time credit?
No, it's
Yearly?
it's overall. I mean, you can accumulate it over a number of years. I think it's per child. Okay. Patient Protection and Affordable Care Act. I just briefly mentioned FSAs. You've probably heard of FSAs, and Tom's probably more of an expert on this than me, but I don't think they're very popular. I don't see very many of them because I think the problem is you don't get to carry them over from year to year. So nobody really uses them, but if you do, you can get a deduction of $3,050. The bigger one is the refundable premium tax credits, which is becoming quite interesting because the upper limit now, if you've got a family of 4, you get 4 times the federal poverty level, which comes to $111,000. It's quite a lot of money. So I actually had somebody talking to me a little while ago, and they're saying they're not finding group policies that can beat the marketplace with this credit. So in other words, you've got a small business and you want to go to the marketplace, at least try and get a group health plan for your business. The premiums that you get quoted, like by Blue Cross Blue Shield or something, are higher than than the employee themselves can get in the marketplace with these credits. And the challenge then becomes, how do you actually compensate them for that? There is a structure where you can do a healthcare reimbursement plan, but that actually causes you to lose some of these premium credits. And the suggestion is maybe it's better to just increase their salary and let them go and get the credit themselves. So I thought that would be interesting.
Right. Because I looked at this a couple of years ago. Where I thought it broke down is great. You won't pay the premiums because if you anticipate the tax credit, they'll reduce your premiums and sort it out on the tax return. But if you blow through that income level and you've been taking the credits on the premiums, all of a sudden you're going to get whacked with the taxes.
Well, I'm glad you mentioned that because that used to be a huge problem. But it seems to be.
And they fix that?
Well, it seems that way. I haven't found anywhere specifically where they said they fixed it, but there's a phase-in now. So when you lose the credit, it used to be like Todd says, it used to be a drop-off, a cliff. You got your full credit, then when you get to 4 times, you get 0. And I had clients who they'd owe $15,000 in their tax, and they said, what the heck for? Because they didn't make all that much money, but they made just enough to get over this limit. And suddenly you're squirming around trying to find IRA deductions and SEP deductions and things that get that AGI below the threshold. But now, if you do the math now, it seems that it's a sort of graded situation, that you start to lose those premium credits steadily until you get to this point. If you get to 400%, then you lose it entirely. But it goes slowly up to that. So just watch out for that. When you go and get your quote from the marketplace, they give you the amount that you're entitled to. Just remember that at the end of the year, you might end up having to pay it back. And
it was a very big problem for us. I did this for business companies there going through the marketplace, and yes, they were strict. I don't know if they've loosened it up or anything, since I've been doing it for the past couple of years. But they are pretty strict about it. So you want to, if you're talking to, or if it's in your business with your employees, you're going to go through the marketplace like this, or for someone that you do know, they do need to, if they're going to use the tax subsidy, which can be very good for some people, they better make sure that they have a good, solid income, what they're stating on that when they're going through the marketplace. Because if they underestimate to try to get that credit, yes, they will owe it for the year.
But you can change it during the year by saying that you estimate your best knowledge and it's changed. I'm not sure that'll.
You can make those, yes, you can go in and make those adjustments. You have to get with the marketplace and make those adjustments. You can also, not do it, and then at the end of the year, you can file it and get the credit, for the end of the year. But most people want to take it when they, when they have to pay those extra premiums. So.
Yeah, I mean, it gets calculated on your tax return, so you can also just set the money aside and know that it's coming. So when the bill comes, you just send the check in. But yeah, I got a client who's, I think his premium's north of $2,000 a month, and he's getting a full credit for it. So end of December, we were scrambling around to make sure he didn't go over, and that's where I did the math. That, like you say, Todd. Yeah. So. That's interesting. Small business premium tax credit. There is a credit for small businesses that's under 30 employees, I think, who can get a credit towards whatever they pay on behalf of their employees. And there are rules around, it's got to be equitable, and you've got to pay at least half of the employees' medical insurance, health insurance, and then you get a credit. But it's not always, it's up to 50%. Now, I looked at it end of last year, it didn't look too attractive to me. So, but it's there. And, look at it and evaluate for your own situation. Interesting that large employers over 50 have to have health insurance. So it tells you where the law is going in terms of providing health insurance for everybody. Force employers to provide it, basically. And then I'm not going to talk about Archer, but I'll talk about health savings because they're pretty much the same thing. These are the more popular plans that I see now, the health insurance, health savings plan. So basically what a health savings plan is it's an account that the IRS allows you to contribute to, get an above the line deduction. So it's not on your standard deduction schedule. This is straight off your adjusted gross income, up to those limits, these limits here. And that was in 2022. They're obviously higher for 2024. 8,300 is the limit for 2024 for married filing jointly. I just did someone's payroll this morning. If you're over 50, you can chip in another 1,000. And the interesting thing a lot of people don't know about is if you're married, and say you're the principal account holder, you can put in the 7,750 plus the 1,000, and then you could say to your spouse, go and open your own HSA, and you could put in 1,000.
Additionally, you can even invest it, not touch it, so that when you do retire, you can pay all of your medical expenses in retirement under the HSA.
So the whole thing is that, having an HSA and also doing this for years, the way it works is you have to have a qualified high deductible plan. Yes. You work that in conjunction with the health savings account. As long as you have that qualified high deductible plan, that means first dollar, every dollar that you spend in medical expenses up to that deductible that you have is, goes towards that deductible. And then once you hit that deductible, then it's 100%, your insurance is 100%. So if you know that you're going into surgery or whatever, you have a $3,500 deductible. Once you hit that $3,500, boom, drugs, everything, expenses for doctor visits, all that's paid at 100%. Which the HSA, the dollars there, is supposed to be used for that gap. But a lot of people, the whole thing is to try to manage that and pay the out-of-pocket expenses, put those HSA dollars into a savings account, let it grow interest and all that. As long as you're using it for medical expenses, even after you've had that qualified high deductible, in retirement or whatever, you get to use those dollars tax-free. So that's the way the HSA works. A lot of companies now, I don't know if y'all doing it at Beaver Electric, but what you're doing is you can actually have two plans. You can have one that's your traditional copay plan, and you can have this HSA plan, and you can incentivize by putting a few dollars into the HSA savings account for your employees, and then let them contribute and start building that up and start in that direction. It's phenomenal. It's fantastic. People understand it. I've been doing it for years, and we've got a nice little nest egg that we're going to use for medical expenses when I do fully retire. So.
Can you, I don't mean to put you on the spot, but can you explain the difference between deductible and out-of-pocket?
Well, so a deductible, a lot of times you'll have a co-insurance, what we call co-insurance, between that $1,500 to $7,500 on the max out-of-pocket. So you'll meet the deductible in your HSA, then you have a little co-insurance at maybe 30% or whatever that you'll still pay out of pocket until you reach that $7,500 max out of pocket. But once you hit that $7,500, if that's what your plan has or set up for, then after that it's 100%. So that's how that.
Thanks. Right. So that's quite right. As long as you've got one of those plans that meet those requirements, then you can make use of the HSA. Yeah, and as I say, it's tax deductible, so a lot of employers actually include it in the compensation structure, and you get a benefit every pay period from it. And Inflation Reduction Act, moving along because I think our time's running out here. Inflation Reduction Act. Energy efficient improvements to your home. To me, this is weird the way they do this. The form is just a nightmare to fill in. But basically, they're offering you a 30% of the cost of certain types of improvements up to limits, and then they give you 30% of other types, but up to a higher limit. It's basically the same thing. It's just different upper limits that you can claim. And if you look on the form, you've got to look at whether it's the top section of specified improvements versus the bottom section. You either get a maximum of $1,600 or a max of $2,000.
Well, I spent $50,000 on windows last year. According to that reduction, the tax would be.
Yeah, you'd get 30% of that, but it's limited to $1,200, right?
Up to 12.
Yeah.
Let's spend it all in one place.
Yeah.
You get one window, that's all you get.
One window.
That's assuming there's no income based on it, right? That home energy audits, I get
But then your house is worth
energy audit from Duke
100 years
Power
Every month.
every month.
Do they
I
charge-
show you that paperwork and we write it off?
Yeah. Do they charge you for it?
No.
Yeah. Well, you've got to pay something for it. You can only claim a deduction if you've actually incurred an expense.
I see.
Yeah. Then the new, basically tax credits for EVs. Also, just an interesting thing. Everyone talks about it. Talk to your CPA or tax advisor about this, because there's a ream of restrictions. Like, the engine's got to be so and so, the battery's got to be so and so. And I didn't want to go into all that detail now, but it's basically $7,500 for an EV. And the interesting thing I thought about it was that Tesla, you may remember the old incentive was based on the number of vehicles that the manufacturer made. I think it was 200,000. When the manufacturer exceeded 200,000 sold EVs, you didn't get the credit anymore. So I had clients saying, oh, I'm going to get a BMW, I'm going to get a Volt or whatever, because Tesla doesn't give them the credit. Well, this has brought that back now. So you can now get a Tesla and get your $7,500 back. And then Secure Act. This is talked about a lot because it's this is 2.0, version 2.0. Came out a couple of years ago, but this was done end of December 22. And it affects a lot of the sort of retirement planning world. A couple of items I picked out is expanding retirement plans. If you have your own business, it's quite nice because you could actually set up a 401k plan for your employees, and you can get the setup costs, the administration costs as a credit. So the government will basically pay you for that, for the first 3 years. So, that I think it was $500 each a year. 50% of it not exceeding I think it should be 500, not 5,000. And then another interesting one here is you actually can get a credit for the employer contributions for the first, for the first 5 years, based on that sliding scale, that reducing scale. So that's quite an attractive proposition. If you're, the contribution basically is if your employee is contributing 5% of their salary, then the safe harbor for a 401k is normally 4% that the employer would contribute. Well, this is saying that the government will actually give you credit for that 4% that you're contributing. And it's a big incentive for employers to try and get people onto retirement plans and obviously take that burden away from government at a later stage. And then the last thing, RMDs. So required minimum distributions, big issue because when you get to the age that you have to pay RMDs, the penalties are pretty steep if you don't make your RMDs. The whole concept is that the government wants your IRA to be reduced to zero, and they want to collect all the tax they can on it by the time you die. So they'll take your life expectancy at the required minimum distribution beginning date, take your life expectancy and say, right, you need to pay out X amount per year for the rest of your life, and we're going to tax you on that. And that's a big number. If you've worked in corporate all your life and all your money's gone into a 401k and that's what you're living off, this RMD kicks in at various ages, gets added to your Social Security. Now your Social Security gets taxed, and suddenly you've got a big tax bill, which you weren't expecting. What Secure Act did was it increased the age. Because of life expectancy is increasing, they pushed the beginning date from what used to be 70 and a half years up to 72. Now it's 73, and it's set to go up to 75 in years to come. And basically, the rule is that by April the 15th of the year after you turn that age, 73 in this case, this year, you have to have made that RMD contribution. If you don't, I think the penalty is 25%, right?
50%.
No, it's down to 25 now.
Oh, it dropped.
Yeah, they dropped it in the Secure 2.2.
Can you mitigate all of that with a qualified charitable distribution?
Yes, you can. Correct.
So you can send it to the church, or to the common part, or to Great Harvest, so you can mitigate that.
Yeah, this is a great point Alan makes. We talked right at the beginning about limits. There are limits. Your adjusted gross income, your total income for the year, limits certain deductions that you can get. If you can reduce that by doing what's called a qualified charitable distribution, then you can qualify for more deductions. So what a qualified charitable distribution is the government says you have to take a distribution. Well, what if I give all of that to the church, or I give it to my favorite 501c3 charity? What the code now says is, because it's a QCD, you don't have to include it in your income. You don't get the deduction, but you don't include it in your income. So your AGI comes down, which means your other deductions are bigger.
You spend your tax instead of the government taking your tax.
It's a great tool.
So, Craig, if you own a business, then you have am I going to make my charitable deduction personally, or am I going to let the business make the charitable deduction? And it all depends on where you are on that age.
So on that thing, the only businesses that deduct charitable deductions are C Corps. So C Corp is a corporation that pays tax in its own right.
It's kind of off to the side. It pays 21% tax, and you pay tax to the government structure. That can deduct distributions, and it's based on a percentage of revenue. It's 0.5% of revenues.
But if you're S Corp,
Any
actually it all goes personal.
all goes personal. There's actually a line on your K1, about halfway down, you'll see a line there saying charitable contributions, code A, and you stick that on your personal return, and it goes straight into your standard deduction calculation.
So it's taxable to
Got
Yeah,
it.
it's added back, so your profit is,
Okay,
it's called
yeah.
non-business deduction. Anything else? So that's,
The financial crimes enforcement, is that something we should bring up or no?
I prefer, so we're in a funny situation as accountants because the lawyers get very jealous of us and they don't allow us to give legal advice. But then we say, but we do tax law. That's law. Oh, well, okay. We'll let you do tax law, but nothing else. This act, the Corporate Transparency Act, is apparently not allowed to be discussed by CPAs. All I can tell you is,
Sal tells me.
yeah, all I know at this stage is there's an exemption for existing businesses, no, not an exemption, extension through February 2025. But if you start a new business now, I think you have to file with the FinCEN within, 2.5 months or something like that.
60, 90 days.
Yeah, something like that.
And of course, nobody knows about this, so everyone's
Yeah, it
scared
just-
about
But the penalties are crazy.
I'd say $500 a day.
For someone who's libertarian and doesn't like regulation, this just blows my mind. But there it is. It's the law. So, anything else?
A couple years ago, Congress passed something where you have to register your business with the federal government. Yeah, that's what you're talking about, right, guys?
Yes,
This is the beneficial ownership.
Yeah.
So you have to. What they're saying is, if you own a business, you've got to tell the government who owns it. So you could have your business and a trust and a corporation and a trust.
So
They want to know.
money to some weird, Antarctica sea.
It seems to be because of all these shenanigans that have been going on in DC over the last few years with all these shell companies and everything. I guess that's the response to that. But what makes me mad about it is why do we're just going about our lives, just doing our things. I mean, it's my business. I own it. Now I've got to fill another form in because some guy somewhere else is playing games. Anyway, what else? Appreciate your time.
Thanks, Greg.
Hope that helped.